sat down with Anacacia Capital's Jeremy Samuel to find out more, beginning with an ABC of just exactly what private equity is.
Look, Carson, I guess the way I think about private equity is it's effectively investing in private companies as opposed to public companies. There are a few exceptions to that, but predominantly private companies, and it's equity as opposed to debt. So in other words, a traditional private equity fund would go for maybe a 10-year closed-end fund, and over the course of that time, they'll invest in 8 to 12 businesses as a shareholder. They get involved in the businesses as typically as non-executive directors, try and add value to those businesses, help them to grow, and then exit those businesses in a way that hopefully the business is a lot better at the end than what it was at the beginning. And that's in its core, I guess, what private equity is. And you're right, there's often not a great deal of understanding of private equity, although the awareness is significantly higher now than it used to be.
A lot of people, Jeremy, also perceiving rightly or wrongly as private equity as being really at that top end of town, the $100 billion buyout proverbially. Now you've chosen to go the other extreme, the small, medium-sized business. Just explain essentially why you did that.
Look, I think from an Anacacia perspective, well, there's definitely a market for larger buyouts, and we've seen a lot of those over the last few years. The traditional focus of the private equity returns and the traditional focus of the Australian economy is really on small, medium-sized businesses. Depending on which data you look at and believe, there's somewhere between 500,000 and 1 million small to medium-sized businesses. And unfortunately, from an Australian economy perspective, there actually aren't that many private equity firms anymore that are focused on that area, because the average private equity fund is significantly larger now than what it used to be. There are actually fewer managers now than there were 5 years ago. And as a result, there's a large level of demand, if you like, from small and medium-sized businesses, particularly succession-type issues. There are a lot of people that are in the baby boomer sort of generation that have founded businesses and built them up. The kids may or may not be in the business, but are probably not the logical owners of that business going forward. And they're caught between a rock and a hard place, wondering, well, gee, I don't really want to sell to a competitor out there, but by the same token, I do need to deal with the succession. I'm 64, or I'm 73, or I'm 58, and I need to start looking at ways to how I can crystallise that value. And that's how a private equity firm, like an Anacacia Capital or other private equity firms, can really assist that owner to deal with those succession issues.
Building up that business is all well and good, but when you're looking at the slew of companies out there, surely you're going to have to narrow down the list of available ones because of certain benchmarks. And if so, what are those benchmarks?
Look, the main thing that we're looking for is really an established business with strong cash flows. We typically focus on businesses that have a turnover of somewhere between $10 and $100 million. Sometimes they're a bit smaller, sometimes a bit bigger. But the most important factor, without a doubt, is the quality of the management team. And for us, when we're looking at making an investment, either we'll back the existing management team that may be buying the business from an owner that's now passive and starting to step away, or maybe the next level down of management, or we'll help that owner identify an external manager that will come in, invest a little bit of money alongside us, take over the reins of that business and really help to sort of grow it and grow it over time. So it's strong cash flows and quality management team are the main areas.
In terms of over taking over someone's baby. I mean, they've built it up from scratch. How problematic, how much of a tussle do you often find yourself in with the owner of the business and you coming in wanting to effectively provide the oversight that you know is necessary?
Look, it really depends on the business. You know, the vast majority of founders that we meet with, you know, their business is like a baby to them, and there's a very strong emotional commitment to it. And it's one of the reasons why they haven't yet made that step towards dealing with those succession issues and actually selling the business to a competitor. Because part of the concern is, do I risk selling my business to a competitor and they come in, do their due diligence, have a look at everything in my business, and then say, you know what, we're not going to buy it. And meanwhile, they know a lot about our business. At the same time, it's unsettled the staff. You know, a culture that we've built up over many years, and it gets threatened. So that's one of the attractions of private equity, is really an alternative to an outright sale, and it's something that we've looked at, you know, several times and done several times. Is actually a staged sell down, where the founder of that business may reduce their equity involvement in the business, still maintain control over the things that are important to them. We have control over the things that are important to us. But in reality, it's very, very rare for us to have a different view around the board table about what to do, because we're all shareholders in the business, and therefore, and that's one of the beauties, I guess, of private equity, is that the interests are aligned if you do it right. So the management team, the founders, the private equity firm, if they're all equity holders, you might have some robust discussion. We always have robust discussion, but everybody's coming from the same objective to really enhance the shareholder value and help grow the business for the stakeholders that are important to that business.
So they presumably would have moved what beyond any archetypal mistrust that might have been out there, perhaps because of lack of transparency over the whole private equity arrangement?
Look, I think as an industry, we probably haven't done a great job getting out there and explaining what private equity is about. You know, we often find that we speak to people and, you know, their level of understanding is quite low of private equity, and sometimes they're worried about the risks of that. And what really matters then is really to sit down, meet them, become real people to each other. You talk about what are the issues that are of concern, what are their plans on a personal level, on a business level. What we care about is really saying, what's the key strategy for this business? How do we help grow it over the next 3 to 5 years? And then we'll put in place the right capital structure to help get there.
In terms of that capital structure, though, you've got your investor pool of money that is now closed off. You've arguably got you've got no option but to go to the banks to fund a lot of these buyouts. Where are the banks in Australia when it comes to lending to private equity? What sort of levels of trust have we reached in this moment of time?
Yeah, look, the banking market at the moment is perhaps better than it is in the US and Europe, but it's definitely, the credit markets are definitely very, very tight. You know, a lot of the opportunities that we're seeing at the moment are people that are saying, you know what, I was looking at making this acquisition, or I was looking at rolling out some more stores, or I was looking at growing my business. I thought the bank was going to be there to help debt fund me. They're not prepared to lend me money, so now I'm interested in getting an equity partner. And so there's that set of opportunities. The other thing that we're seeing is that the banks are actually being choosier and choosier about who they're going to lend money to. And most of the banks now have specific areas dedicated to lending money to businesses that are backed by private equity firms. And I think part of the reason is that they feel more comfortable that if it's a well-managed, responsible private equity firm, then that helps put a stamp of approval, if you like, on the business, where the governance will be right, that there will be people who are shareholders in the business that will help guide the management team. The accounts are audited, everything's kind of, clean in that sense. So, banks, I think, generally like cash flow lending to private equity-backed businesses, although on the current environment it's definitely very, very tight. And, that in itself sort of creates a new set of opportunities, but we certainly see a lot of small, medium-sized businesses at the moment that are finding that debt markets are a struggle in terms of getting debt finance.
Of course, it's picking those businesses well that are going to achieve and fire and do what they say they'll do on the tin, because the world has changed a lot in a couple of years, as you well know, Jeremy. How difficult is that to really pick the winners amongst a sea of wannabes?
Yeah, look, the biggest challenge for us when we're looking at new businesses, as I say, we're really focused on the quality of management, but the biggest risk factor we look at is how much can we believe the cash flow forecasts of the business. And we really spend quite a lot of time working together with the vendors of the business or the management teams of the business to understand those and run a lot of sensitivities. And just because the business has grown historically, particularly in the current environment, I think the average business is definitely not going to grow at the same rates in the future as what they have before, and will possibly go backwards. So that's definitely something we spend a lot of time focusing on. And when we think about sort of capital structure, for some businesses it makes sense to put no debt in there. So sometimes we'll invest in our equity into a business and we'll say, you know what, let's actually not put any debt in there at the moment, because the future earnings may be quite volatile and therefore it's not well suited to debt. Other businesses we look at, we can say, you know what, you can actually predict the future cash flows of this business really well, and therefore it actually makes sense to put quite a bit of debt in there to help enhance the returns.
Tell me, in this environment though, in terms of the sectors that you maybe have changed and reoriented towards because of what we're going through with the global financial crisis, what in particular has caught your eye?
Look, the quality of the management team for us is more important than the industry. However, having said that, for example, we recently invested in a business that's one of Australia's top distributors to universities of chemicals and consumables. And if you think about a market like that supplies, so its customer base is scientific laboratories, if you like. And if you think about a market like that, as long as we're still, unfortunately, have health issues and things need to go off to a pathology lab, or as long as the universities are continuing to do research, there's a need for those sort of products. So it's somewhat not correlated to the economy. Similarly, we've got an investment in a business that does audio for festivals and outdoor events, which is a booming area at the moment. So there are some sectors that one can find. We're looking at some opportunities of businesses that focus on lower cost but essential items in the household. So there are those sort of pockets. There are definitely other areas which are more discretionary, which are struggling at the moment, and private equity firms are obviously, and the businesses we look at are not immune from the general economy. So there are definitely some areas that are much more challenging, I guess, to look at, and the quality of that management team has to be that much more outstanding to make it work.